Marisa Maggio, and I am super excited to be here today with top producer Rami Hamady.
Hi, thank you for having me, Marisa.
Absolutely, and thanks for being here. So we're going to go over a really important topic, and a topic that I believe in terms of in-home is actually really, it's not talked about enough, or it's not actually absorbed enough. And once you can actually get this concept down, your family's health can essentially go through the roof because you're no longer scared of that lead that's a mortgage lead for, $300,000 on the mortgage and the person's 78 years old. You're not scared of that anymore. That's actually my favorite kind of lead, probably one of yours too, right?
I agree.
So with that being said, really what we're going to cover today is what I refer to as the critical period or equity rescue plan. And I think that it's really important to take those words and understand that just like everything else in this business, it's all life insurance, right? Mortgage protection is a concept, right? Final expense is a concept. Income protection is a concept, so on and so forth. It's all just concepts, right? So we're taking a concept of mortgage protection, and instead of saying, hey, John, here's 30 grand on his $300,000 mortgage, it's not about what it is, it's about what it's going to do for John's family when John's no longer here. Because 30 grand to 300,000 doesn't sound like a lot. Like to me, I'd be like, oh no, I'm good, I'll walk, right? But when you can explain to the family what it does, that's a really, really powerful thing. So times that this is used, or the most common times that, I've used this within my organization is when we're sitting down with an individual who, no matter what their age group is, maybe they're not as healthy as that person with no scripts, no meds, or just that 50-year-old on, that simple high blood pressure medication or whatever it may be. It's for folks who are older, I would say debatably over the age of 60 years old. It's a great concept to use because it's permanent protection. And also when people's health, their health is not there. It's not there to meet the requirement of, a term product. So there has to be another way. And what we're really doing here by calling it the equity rescue, hence, or critical period concept, is we're taking that critical period of time, which is when that loved one is lost, that's most valuable and urgent because the bank isn't really worried about if Mary's going to lose the house. They're actually probably kind of hoping she does if there's a lot of equity in there. And that's when equity rescue comes in, right? So it's that critical time where the family's in a weird situation that this whole life insurance policy is going to come in and it's going to make the monthly mortgage payment for X amount of time. So we're making sure that in that critical time, that individual, whoever it is, that beneficiary, they don't have to lose the home, right? And they can also preserve all of the equity that that individual or individuals have put into the home with hard work over the years. So with that being said, I hope that makes sense. And if it doesn't, think back to a case where you wanted to get somebody termed so bad. And typically you wanted to get them termed so bad because you couldn't help but explain that only term was the only solution to their problem. Whereas oftentimes, folks won't even want to stay in the home, or their kids will sell the home, or whatever it might be. They don't need the whole house paid off. They just need enough time to get the house on the market to make sure that in that critical span of X amount of months where they're trying to go through the crisis of losing a loved one, they're trying to go through their day-to-day changes, whatever, it's going to look different for everybody. But that mortgage payment is made on time, so the bank has nobody to come after in that essence. And that's really important. So again, it goes back to, it's not what it is, it's what it does. Is it important for John to know that he has $30,000 of life insurance? Yes. But if we sit down with John and we say, hey John, we got $30,000 for your $300,000 mortgage, it's going to be $300 a month. John's going to say, peace out, goodbye, because he doesn't understand what it does for Mary when he's no longer here. So with that being said, not a better person that I think really kind of came in and mastered this piece of the in-home and just the in-home in general, which I respect the heck out of you for that. And you really took this part to to your heart. And I remember having conversations with you, and you're like, and you had asked a very logical question, like most agents, which was something along the lines of, and I don't remember the exact question, but when you have somebody who's unhealthy, or how do you pivot basically out of that term product, right? And that was in your first week, and you got it done fast. It made sense to you because you knew once it made sense to you, you could relay that thought in a logical way, right? So super excited to have you here, and really I just wanted Rami, you'd have the opportunity to be able to just kind of hone in, act as if you're in a home, and really just not get off topic. But I wanted also folks out there to be able to understand what exactly it is that you're delivering in this training, because to me this is invaluable. Like 70% of my business is this critical period or equity rescue concept, or so make sure you lean in, buckle up. You're listening to somebody who helps over 50 families a month. So with that, all further ado, Rami, I'll pass it over to you.
Thank you for having me, so I appreciate it. So I'm just basically gonna go over my in-home guys. I'm just gonna pretend like she said, like I'm gonna know in-home. So Marisa, how are you today? My name is Rami Hamady. I'm the field underwriter or insurance broker. Now before we begin today, Marisa, did you fill this form out?
Yes.
Okay, and when you filled it out, what was the purpose of you filling it out? Who were you looking to protect?
I just wanted to make sure something happens to me, that my son will be okay with the house.
Okay, and make sure your son will be okay with the house. Does your son live here as well with you?
He doesn't live here now, but
Okay.
I wanted to go to him, so I don't know if I need this.
Okay, now we'll see if you need it or not. Now, I'm going to be very direct with you and brutally honest. Do I have permission to be as brutally honest as I can be throughout this whole conversation?
Yeah.
And I truthfully mean that. So don't make me write on a piece of paper and keep it in the middle of the table, because I will do that. And I'm going to pick up a piece of paper and say, I'm going to be really honest right now.
No, I think
transparency.
Absolutely. I think I need honesty in this conversation for sure.
I agree. So we're what they call a field underwriter or insurance broker. So all that means is I work with all these companies to create these mortgage protection plans in place. Now I'm not biased or partial to any company. I don't care who you pick. I don't care what you want to go with. What matters to me is getting the lowest, most affordable rate for whatever you are looking to cover. In order for me to find that out, I'm going to talk to you about your mortgage, see how it's structured and how it's set up. I'm going to talk to you about your finances, because maybe you don't need that much coverage at all. Maybe you need a little bit less coverage. I'm the very first person to kind of tell you that. And lastly, I'll talk to you about your health. Not to be invasive, whatever application I submit for you today, I want to get you approved and not declined. Does that make sense?
Yes, it does.
Alright, so reason, remember I told you to be very honest today.
Just
okay,
where?
So your job today is to help me help you. What I mean by that is, you have a budget, I have a budget, your neighbors have a budget. Let's make sure whatever we submit today stays within your needs and your budget. Does that make sense?
Absolutely, yeah.
Alright, so typically the process takes 1 to 5 business days to complete. So if I can't get you a decision today in the home, it's going to go up to senior underwriting for final approval. They're going to fact check everything we spoke about, make sure whatever we spoke about was truthful. At that point, your coverage will be put in place and your policy will be effective. Does that make sense?
Yes.
Alright. So Marisa, how much is currently the mortgage?
So it's 200,000.
Okay. And is that a 15, 20, or 30 year note?
It's a 15.
15 year note. Okay, what was the rate you got it at?
2.5.
Okay. Now, did you refi or purchase this?
It was a refi.
Alright. And the house value, God forbid anything was to happen to you, what do you think the beneficiary could sell the house for today?
The last appraisal in the house was about 500,000.
Okay, so you have around $300,000 of equity in the home, is that fair to say?
Yeah.
I congratulate you on that. You've been working hard for that. You've paid off the mortgage for as long as you paid it, you refinanced it, and now you can continue to pay that down for 15 years. Now, I'm not going to do this to you, but if I cut out the opportunity to take those monthly payments, multiply by 12, multiply by all these years, think how much money you put into this home already.
I know, yeah, I know.
So bare minimum, so we're going to protect this $300,000. No matter what, your beneficiary, your children, your grandchildren will get this $250,000, okay? So did you pay any extra to knock down your monthly payment a little early?
No, I put it on a 15, so I mean I'm already paying $3,200 a month is my monthly.
Okay. And Risa, how old are you?
I'm 70.
Okay. And do you have any mortgage reduction currently in place?
No, not that I know of.
That's why I filled the form out. Now, Risa, I'm just going to get back to why I'm here. So, when you filled the form out, you told me you wanted to make sure you're protecting your home for your children. Now,
well, for my son, yeah.
For your son, okay. So, why am I here today outside of just protecting the home for your son? If you do die, God forbid, you passed away yesterday, what does that look like for your son? Outside of the mortgage, ignore the home, think about your bills, think about your finances, think about how he's going to go to school, think about how he has to relocate. So how does he continue to live his life?
I mean, it would be a lot on him if something happened today. Let's just say all my ducks aren't necessarily in a perfect row.
Okay.
I mean, again, he doesn't live here, so you know, he lives out in New Jersey. So I mean, he would have to be traveling probably here to clean up, you know, the house, or you know, if he's going to sell it and you know, get my stuff out, go my final expenses.
Okay.
I mean, it would be a mess.
So you think he might sell it?
He would probably sell it. I mean, he has his own home in New Jersey with his family.
Okay. And now that makes sense. Most of the families sit down with in your situation. Typically, they want to leave their home for their son, and the son either A, if they have a home and they're building life of their own, they're going to want to sell the home. And that goes back to my point that you want to make sure you give your son enough time to be able to sell the home, vet a buyer, and make this $300,000 above market value. Because what I can tell you, Maurice, is it doesn't matter if you knock down your $200,000 to $1,000. If your son cannot afford to pay this mortgage, they're going to come and foreclose the home. Unfortunately, you're going to have to go through, your son will have to go through probate as well. That's a potential possibility. Not to mention, when a bank sees that there's $300,000 of equity, they're really going to hone in on this property, especially when you pass being the only person on the deed. Does that make sense?
Yeah, I could see how that would make sense for the bank.
Okay. And Risa, currently, do you have any private insurance at work?
Life insurance?
Yes.
Yes, I do.
Okay, and how much do you have it? Is this worth work or is this private?
So no, this is private. I'm retired.
Okay. And how much is the face amount?
I have a $50,000 whole life policy.
Do you want to get that policy for me?
Yes, I got it. It's with company ABC right here.
Okay. $50,000, awesome. Okay, reduced paid up. I like that.
Yeah, I don't even pay them anymore. I just get the dividends.
Yeah, keep that in mind. Okay, remember you told me that. Okay.
Okay.
All right. So we have $50,000 in place. Outside of $50,000, does anything come in to cover the mortgage? I know this is probably going to your estate planning to make sure that your son, when you do pass, is not going to have that big of a financial burden on his life, correct?
Right.
Okay. And do you have a will currently?
Yes, I do.
Okay. And do you have any identity theft protection?
No.
Okay. Marissa, I know you told me you're 70 years old and retired. Now, what's your monthly income after taxes? And I mean everything you get in a month after taxes.
Yeah, so I have my pension's max at $5,800 a month.
Okay.
And then I have my Social Security, which is about $1,300 a month.
Okay. And do you have any significant savings in your bank, Marissa? Liquid, anything upwards of $50,000 or more?
No.
Okay. I see what happened here now.
I mean, I have my pension max is really nice. So.
Yeah, that pension's great while you're living, but the minute you pass away, Marissa,
oh, I know.
It doesn't go anywhere, right?
That's right.
So at least what we're going to do is we're going to allocate a percent of this income right here, that your pension that you're going to continue to receive while you're living. We're going to move it to a place where you're going to give your son an immediate tax-free payout to keep this home and maintain the equity and give him a little head start in life.
Okay, I'm excited to hear more.
Now, are you a smoker, Marissa?
I know.
Okay. And what medications do you take?
Why do you assume I take medications?
I have to ask.
Oh, I'm only kidding now. I do take a couple. I take a lisinopril, 10 milligrams, 1 time a day for high blood pressure. I take a torvastatin. And I take losartan.
Okay. Anything else?
No, that's it.
Now, normally, guys, at this point in time, I would tell her to go with the bottles instead of having her read them off memory, especially being a 7-year-old. And I would read the normal questions in the inventory. Have you ever had a heart attack, stroke, cancer, any major health concerns at this time? So, Marissa, have you had any major health concerns at this time?
I mean, I don't currently have cancer, but I did have a heart attack not too long ago.
I'm sorry to hear that. How long ago was that?
It was about two and a half years ago.
Okay. So it's fair to say that even though you look like you're in good health, that maybe our body inside is not really reflecting what the outside looks like. Is that correct?
I mean, that can happen, yeah.
It happens to all of us, right?
The best of us.
All right.
That's what I say.
I agree. And don't worry, my mother had a heart attack as well. She had a minor heart attack about 15 years ago, so trust me, I can relate.
Oh,
Now,
I'm sorry to hear that.
it's alright, she's still living, she's still breathing, not how interested in that. So currently, if any other major health concerns, a stent, diabetes, neuropathy, I know you have high blood pressure, I know you told me that because those that are going due to your medications. I know you have high cholesterol with the atorvastatin. Do you have COPD, any thyroid disease, anxiety, depression, or kidney or liver disease?
No.
Okay. Now, Marissa, your situation is pretty straightforward. I will tell you that. There's 2 types of mortgage protection plans. There's option A, a full payoff, option B, a partial payoff, and option C, equity rescue with critical period. What I'm going to do is I'm going to call my senior underwriter and give them a call just so they can know exactly which route I'm going to go down, okay?
Okay.
Alright, so at this point I'll take out my phone, I'll call my upline, ring, and I'd go about the whole situation. I'd say, hi, I'll be like, hi Christina, I have a recent sitting down, she's 7 years old, her mortgage is $200,000, the house value is around $500,000, $300,000 of equity in the home. She's currently retired, non-smoker, lisinopril, atrasentan, losartan, had a heart attack back 2.5 years ago. No other health scares, wants to protect the equity for her son. Which route should I proceed? And then my upline will tell me which route to go, and I'll continue. So Marisa, after you heard that conversation, there's 3 types of I told you. There's option A, full payoff, option B, a partial payoff, and option C, equity rescue. Now, the good thing is we qualify for what we call equity rescue or critical period, okay? So how this works is we're gonna take your monthly mortgage payment, I'm gonna right here on the top right corner, $3,200.
I'm sorry, did I say 32? I meant, it's 3,000 even.
3,000 even?
Yes.
Alright.
Sorry about that.
Okay, so 3,000 even. So Marisa, what the case is in your situation, what you really need, what I like to call it's like a bridge plan or a gap plan. So it's not what the face amount is, ignore the dollar amount, it's what it can do for you. It's not how much it is, but what the insurance can actually do for you. In your situation, when you do pass, unfortunately, your son is gonna have to move up here from New Jersey, he's gonna have to collect all your assets, he's gonna have to validate your assets, verify them at the point of death, see where your debt is, and at this point in time, he's gonna go through probate as well. He's gonna bury his mother, and he's gonna have to deal with the real estate office hounding down his neck, either A, trying to foreclose the home, or B, trying to see, hey, where's our money so we don't have to foreclose the home. Does that make sense?
Yeah.
Okay. So what most families will do is they'll put anywhere between, let's say, 30,000, 20,000, or 10,000. Now, like I just said, you're gonna be looking at these numbers, you're gonna be thinking, oh wow, that's such a small face amount. No, this is really 10 months of mortgage payments. This is going to be 7 months of mortgage payments. This is going to be 3 months of mortgage payments. During this time, your son is going to have, during this time period, your son will be able to either A, refinance the home under his own name, B, reverse mortgage it, C, find a buyer, vet the buyer, make it through escrow, and sell the home to maintain that $300,000 of equity. The best part about this plan, Lisa, is one of 2 things is going to happen to you, and I truthfully mean this. A, you're going to die early. Your son's going to get a lot more money than you paid into it. He's going to protect this home that you paid for more than 30 years plus. You're 7 years old. Just refinance on a 15-year note. You got 30 years remaining. That's 45 years already. In addition to that, or B, you're going to end up stop paying for this when you outlive the program. Now you may wonder, how is that possible? No insurance company is going to make you pay $30,001 for $30,000 of coverage. What happens is the minute you've paid the face amount, whatever the face amount is, 30, 20, or 10, it becomes free, $0 forever, or what we like to call reduced paid up insurance. So in layman terms, the minute you've paid $10,000 into this policy, it's going to become $0 a month. You're then going to have an option to either keep that insurance on the side for $0 cost, or you can continue to make payments and collect dividends, and this $10,000 will go up. Now, in the time period when $0, this $10,000 will still go up because these policies gain a cash value in the second year. After year 2, you're going to be able to borrow against this. I don't recommend you doing that because if you take away $5,000 from this, your son only gets $5,000. He's only have 1.5 months of time. That is not enough time for him to collect your assets, sell and validate, solidify your debt.
Yeah, I probably wouldn't be using that cash.
I don't think so either.
I don't think so.
Exactly, but my point in saying that is that this $10,000 can only go up on you. It can never decrease on you unless you take it. However, your premium payment can go down. So it's the opposite. Instead of actually your death benefit decreasing and your premium payment increase, with how some increasing term products will go, the opposite will happen here. Your premium payment becomes 0 and your death benefit increases as long as you're living. So like I said, you're doing one of 2 things here. You're either going to die and your son's going to get a lot more money than you paid into it, or you're going to outlive the plan and you just move money from a bank, which is a liability, because currently when you do die, your account has a potential to be frozen. I'm not telling you it's going to be frozen, but I'm telling you there's a potential for you to go through probate and the potential to be frozen. Now, we want to avoid that kind of headache. So what we do is we allocate a percentage of that money that's in your bank, and we're going to move it to an insurance policy that pays out a tax-free immediate payout to your beneficiary and gives you access to funds just like in a bank. If you were to save that $20,000, it would save the same exact way, except it's going to accumulate more interest than 0.02% interest in a saving account, and it's going to provide you peace of mind for your family. So I like to look at this like you kill two birds with one stone. You protect your money and you're protecting your family at the same time. Does that make sense?
It does, yeah.
Okay. So Marisa, now I know most importantly you want to know what the payments are.
Yeah, I've been waiting for that.
Okay, so Marisa, like I just mentioned, the payments here they don't matter because truth be told, you're 70 years old. You have already money saved in the bank. You make $5,800 pension, and on top of that, you told me you get I believe $1,300 on the side. So that money, that pension money, is just going to go away. It's going to disappear, correct?
Right.
Is it go to your son when you die?
No.
So wouldn't you want to take at least 10% of that money and make sure that your son's going to automatically be able to receive some of that income?
That would be nice.
So it doesn't matter how much these plans cost because all we're going to do, we're going to take money from that pension and we're going to allocate it to this policy to make sure that when you do pass, this home is not lost, that all the money you put into it is not gone and your son can maintain that equity. And not to mention, if y'all live busy, guess what? You can go on vacation. You can think of this like a secondary pension. You can withdraw that money and keep it. You imagine you hit the lottery, you guys sell the house, you go to Aruba together, you can take your son on vacation.
There we go, that would be fun.
Does that make sense?
Yeah, he owes me a vacation.
I bet he does. So which one of these options do you want to qualify for?
I mean, I don't know how much time you would really need.
Okay, so the average family is anywhere between, I'd say, 3 to 6 months. Now, I would never want to give my son on the worst end of the spectrum. I like to go in the middle. I like to take the best possible situation and the worst possible situation. The worst situation would be he does not sell the home in 3 months, cannot find a buyer, and the bank comes in and forecloses the home because he's going to be paying 2 mortgages at that point. He has his own family. He has his own bills to pay. So I would recommend going anywhere between 6 to 12 months. That's going to guarantee that he's going to be able to sell the home.
Okay, I understand what you're saying. Well, yeah, right now, I mean, houses are just flying off the market. So, I mean, it would probably wouldn't take him 3 months, but with him having to come up from New Jersey and, his wife isn't very supportive of him coming up here and he has kids and stuff.
Remember, so especially on that point, now it's wishful thinking that your son can sell the home in 3 months. That's going to be very realistic with you here. If you just think logically, when you sell anything, especially now, like you said, with the pandemic going on, and even with the market with how it is, people aren't going to just walk into a situation and say, I'm going to pay $500,000 for a home right away. They're going to do their due diligence. They're going to take their time. They're going to research. They're going to make sure it's the home they want. That your home is not the only home they're looking at. Think of that same situation for your son. You want to make sure he has enough time. God forbid, 4 months goes by, 5 months goes by, and he doesn't sell the home. And you're looking down and you're thinking, oh my God, he hasn't sold the home, and all that money, all that time I put into this home is gone.
No, we can't do that. You explained that makes a lot of sense. So I would like to see him with at least 6 months of payments, at least.
With 6 months of payments?
Yeah, I mean, preferably I'd like to look at that top option, the 10 months.
Okay.
So I would like to look at the top or the middle one.
Alright. So another reason I'm just going to pull on my iPad and I'm going to see if you qualify. And then we're going to do, we're going to get an application. In order for me to do so, I need your driver's license and a voided check.
Okay, so I'll grab that for you. But Robbie, you still haven't told me how much it's going to cost, so I don't want to give you the check until I know what it's going to cost.
Okay, so I understand now. I want you to tell me, you said you think you need between 6 to 12 months, correct? How much time do you think your son truthfully needs?
I would like to give him 9 months.
9 months of time? Okay.
Yes.
So I'm going to show you 6, 9 months, and 12 months of time, okay?
Okay.
So these numbers may not accurately represent the month of time. This is just an example I was giving you, okay?
I understand.
Alright. So we'll say the top one is 200, the second one is 150, and the third option is 100. These are your prices.
Alright.
So how this works here, just like I told you, it will become free. It'll take $10,000. You'll divide it by 100, which will give you 100 divided by 12 months in a year. In 8 years, you would have free insurance. So if you don't pass away within 8 years, this would be free of cost, and the $10,000 would increase over time.
Okay, I don't want the 3 months.
Okay.
I like the top one, the The 200.
The 200 one? Okay, so it's the same exact way. You just do 30,000. You divide it by 200. Divide that by 12. 12 months in a year. In 12.5 years, you would have free insurance.
Okay, great.
Alright, so you grab your driver's license and a mortgage check.
Yeah.
On my application, and I'm just begin the let's go through the questions as is.
Okay, awesome. So a couple things I just want to hit on is, so great job, Rami. Great job. Like, I'll clap it up for you there.
I think I did a little better. It's okay. I think I've done right a lot of times, but it's alright.
Thank you. And here's the thing, though. It's your rabbit hole. Yeah, I can see that, but it makes sense, right? All you're saying is, hey, Marisa, I want to make sure you're understanding that it's not what it is, it's what it does, right? You pointed that out beautifully, and you don't make this whole complicated, spreadsheet. He literally wrote down in this piece of paper here, he wrote 10 months, 7 months, 3 months. And then he wrote 10,000, 20,000, 30,000. And then eventually, he told me how much it cost.
And guys, and I really do that in the home. Now, I really, especially with Equity Rescue, now if it's any other product, of course I'm going to quote them because they're going to really need to see how much it costs to see what the amount of coverage they're going to get. But in regards to the Equity Rescue critical period, you really want to get that point across that it does not matter what the cost is. Now, of course, guys, everyone has a budget. Like I told her, I'm not here to make her insurance for it, and I'm here to find something within her needs and her budget. However, I did want to make that point very clear as well, on the other hand, that it does not matter what it costs because you want to protect your son. You want to make sure you keep this home. And you can drill that point and get them to agree with you, and then you show them the quotes, no matter what, you're going to protect that family. If you go into it just by showing the quotes, they're going to look at the piece of paper, and especially her being 70, it wouldn't have been 100, 150, 200, it probably would have been 250, 375, 480. And at that point, even if I'm telling her your son is literally going to go through hell when you're gone, and she's looking at $500 a month payment, she's going to tell me, I'm so sorry, I can't manage right now. I'll think what I can do. When I leave, she'll start thinking about it, and then she'll maybe give me a call back, but at the same time, you don't want to do that. You really want to express to the client why you're there, why they need it, and that you're there to help them. And if you can just keep bringing up their why and showing them that, hey, if you don't need this coverage, I'm going to leave your house today. If you need this coverage, I'm going to stay here, I'm going to help you. As long as you keep that mindset that you truthfully want to help and protect that family, it really doesn't matter what the cost is because they do want to get protected eventually.
Absolutely. And real quick, just last thing to piggyback off of the whole price point. Of course, you're going to tell your client what they're paying. That's not what you're saying. You're saying you usually just have them sit down, you initiate the application, you get it started. However, when I'm in home as well, I do the same thing in regards to I'm not going to show you how much it costs until you understand everything. Because the moment you see a price on a piece of paper, you don't care what I'm saying. You stop listening to me. You're just looking at the price. You're just looking, like you said, at the 150, the 100, and the 200, or
exactly.
Whatever it would have actually been, right? So you're not honed in on what it's going to do for the family. You're honed in on how much do I have to pay, right? And even with, this fake example here and that income, it's like I've done that before and made that misstep and have not protected families because I was explaining it so hard, but they were just looking at the number. Yep, so love that. Anything else you want to kind of wrap up with that you think is important in regards to the equity rescue or critical period concept?
Yeah, so I wouldn't focus too much on that reduced paid up portion. Now, obviously, as you go through time, you're going to understand that all that means is free insurance forever. But don't hone that. Don't make that your selling point. Really explain it's a bridge plan. It's just gap. It's meant to give them enough time to cover the critical period to come in and save the equity. Hence, equity rescue. Just think of it like that. You're literally covering a critical period of time when stuff hits the fan. And you're coming in to save the equity, which in essence means you're rescuing the equity. That's it. You need enough time to put in place. Take their monthly mortgage payment, multiply that by whatever you want. If you want 3 months, 4, 5, 6, that's all you need to do. Take that monthly mortgage payment, multiply it by however many months they need that you truthfully think they need to sell the home, and that's it. And then explain to them that, guys, and this is probably your best option because at the end of the day, you can explain to them that you're never going to lose money. And then you can get into that point. But I would always just really hone in on this is meant to protect time. It's meant to give you enough time to sell the home and protect the equity.
Absolutely. Bridge that gap. Love that. All right. Well, Rami, thank you so much for being on today. Thank you for this awesome training. If Rami, if somebody wants to reach out to you, they can reach out to you. What's your Instagram?
Rami Hamady underscore.
All right. Awesome. Well, thank you so much for being on with us today. I appreciate you, and we'll
Thank
see you
you.
next time.